Hi, everyone. Sorry that we're starting a little late today. If you can hear me, can you please raise your hand? Thanks. So I will share my screen with you all now, and we'll get started. All right, so today's webinar, we do this once a month. It's only 20 minutes long, and then we'll open it up for questions at the end. Today's webinar is on the how-tos on practicing effective credit risk management. A little bit about our company. We're Anytime Collect. We're an automated accounts receivable software, and we automate everything from the creation of the invoice, sending it out to your customers, email communications, to finally getting paid in our online bill pay portal. So the agenda for today, we're going to go over the pros and cons of extending credit, best practices for credit applications and trade references, business credit scoring strategies, and best practices for credit reports. So first, what is credit risk management? It's the lender's primary line of defense to protect themselves against customers who fail to pay back the credit that was extended to them. Using credit risk identification and management is important to ensure the lender does not take on more risk than they can handle or afford if the borrower fails to pay. So it's pretty much just expecting that you're not going to get paid and using that to proactively make sure that you are not becoming a lender that never gets paid back. So why bother with credit risk management? The longer an invoice goes unpaid, the less likely it's that the invoice will ever be paid in full or at all. So the average company usually has a situation that looks something like this. 39% of invoices are paid late. 17% of customers do not adhere to credit terms. 48% of customers delay payments, or 52% of businesses ask for extended payment terms. And these stats are coming from Paystream Advisor's annual credit management report. So these are stats from other companies that are probably experiencing the same type of delayed payments or no payments at all that you might be. So the pros of extending credit to customers. There's pros and cons to everything. So the first pro to extending credit is being able to establish trust. If you're a company who's able to offer reliable, stable, trustworthy, then you are able to offer credit and your customers can see that. And it's a comfort to current and potential customers. It breeds customer loyalty. If you are a company that is able to offer credit to a customer so that they are able to purchase these products from you versus a company that's not able to, then you'll be able to have customers that are loyal and they keep coming back to you. So you're providing them with an option for credit so they have cash flow flexibility. It enhances your reputation. It's not something that every business can afford to do. I mean, people talk. There are companies that are friends with other companies, and so if they let their friends know that you are able to offer credit, then it will boost your reputation in the industry. It increases the amount of money that customers spend with you. Statistics show that customers will spend more money when they do not have to pay cash up front, which allows you to quickly build revenue. So by offering credit, you'll see an increase in sales volume. It allows you to gain a competitive edge. Not all businesses are extending credit, so this just gives you a leg up by offering credit to customers. And like we said before, it can increase your sales. So it can help you attract more prospects and close more deals if you're able to offer credit to customers. And like we said, there's cons to everything too. So these are the cons that we found of extending credit to customers. You're basically taking the position of the bank. You're financing these purchases for your customers by extending credit. So that obviously comes with risk. You will have customers that are great, that pay you on time every time, but there's also the risk of offering credit to the wrong customer that's never going to be able to pay you on time, or that just chooses not to. You'll have to focus more on your accounts receivable management. So if you're deciding to start selling on credit, then you're going to need to make your accounts receivable management a top priority. everything from sending invoices to the organization, dealing with invoice disputes and late payments. You don't have to deal with late payments if you're not offering credit. So this puts more of the responsibility on you to collect on these payments. It can affect your cash flow. When you ask your customers to pay up front, you know exactly what your income is every month, but when you're selling things on credit, then that can affect how much cash flow that you have because you're waiting on your customers to pay you. Collection fees, it's not always free, so sometimes you'll have to pay someone to follow up on the invoices, and you'll have to put systems in place to make sure that you're organized, whether that's using a collection agency or using a collection software to be able to collect on all of these open invoices. And the credit sales will cost you time. So collecting outstanding invoices is a lot of work. So you might have to hire more of a larger team. There's paperwork. You have to create and send invoices, calling customers, and even if it gets down to it, having a court date or a bill collector. So the next step is what to include in your credit applications. So a credit application allows you to really assess whether a customer is a risk to your business to offer them credit. So by using a credit application, you can help identify these companies ahead of time who will be a better customer than the rest and how much you can end up giving out in credit to these customers. So on the screen, we have a bunch of different areas of a credit application that should be included if you're creating one. Everything from the name of the business down to their business or their personal bankruptcy history, especially trade payment references. We'll talk more about that later in the webinar, but that's a really important thing to include on your credit application. The more comprehensive your application is, the better you'll be able to get an idea of whether this is a potentially good customer or a potentially bad customer. And some of those areas that aren't up on the screen but will give you a more comprehensive application are things like profitability, financial ratios, cash flow, debt levels, and an industry evaluation. Managing your customer credit application. So once you start using credit applications, there's going to be a lot of documents that you're going to have to be able to organize and keep track of. So if they're not being stored correctly or securely, it can put other businesses at risk that you're looking over, and it can also put you at risk if you can't find those documents again, and then you're handing out credit to customers that may not be worthy of it. So by using an accounts receivable management software that has document management features in it can really help with the organization and management of your credit application. It can allow you to save a template in the system so that you're cutting down on time creating and editing new ones. You can send them to customers and they'll receive the document through encrypted emails or through a secure customer portal. And it also allows you to manage and store and share the other documents such as invoices, proof of delivery, timesheets, but also the additional documentation that comes with your credit applications if they're sending you bank statements or other types of documents. You can also set up the software to notify you when it's been a certain number of days, months, or years since the customer has filled out the credit application, because you aren't just sending out this credit application and having them fill it out once and then you're never talking about it again. Your customers' finances can change all the time, and so you have to be maybe annually sending out these credit applications to your customers to make sure they're still worthy of your line of credit. Beyond just getting the trade references on the credit application, your customers will probably give you the name and phone number of someone that you can call, and it's not good enough just to get those trade references and then not follow up on them. So it's important that you're following up on the trade references that are given in the credit application. Up on the screen now, we have a couple questions that are really important to be asking these trade references that are given to you by your customer. So is there a pattern of paying some suppliers on time and some late? Is it seasonal? So some of your customers might have a specific time that they tend to sell a lot of their products. So they have a lot of cash flow at that time, and they'll be really great about paying maybe in the winter. But then in the summer, they tend to be more delinquent. And it's important to know that before you extend your credit to this customer. And you can glean a ton of information from the trade references that you wouldn't be able to know by just talking to someone and having an existing relationship with them. Some credit scoring best practices. So once you have these credit applications and you've spoken with the trade references, you'll want to start scoring these potential customers to help decide how much line of credit that you're willing to give to them. So the first best practice is to match your scoring with your corporate objectives, customer base, and processes. For example, if your goal is to reduce DSO, you need to reduce the number of customers who are chronically late to pay their invoices. So do you have enough information for statistical samplings from customers? Do you have enough bad events to generate a behavioral pattern based on your customers? And then focus on creating greater efficiency. Credit scores can help you drive efficiency in your credit approval and monitoring procedures. You can make more decisions in less time regarding your customer credit and speed up workflow. Use data from as many sources as possible. Look at your internal data as well as information from commercial credit bureaus to increase predictability and accuracy. And then keep your accounts receivable information up to date and organized. Like we said before, your customer's credit is always going to be changing, so it's important to keep up to date with all of that information. Next is calculating your customer's credit limits. So we have a couple different ways that you can do that up on the screen. The first one is the net worth calculation, which is we have a formula there, which is the customer's total assets minus their total liabilities and then divided by 10. The result will be 10% of the customer's net worth, and that's a good benchmark for setting their credit limit. You may consider basing your limit on 10% of the customer's working capital or average monthly sales. The next calculation is a trade reference calculation. So this will give you an idea of how much other creditors or competitors have extended to the customer. So your trade reference calculation is based solely on what credit limits are given to the customer from the trade references that you've spoken to. What are they already getting in a credit limit from other companies? And then you can base it off of that. You can either mirror this trade reference calculation, or you can decide how much you're willing to give based on what others have given. There's a needs-based calculation. So how much did your customer ask for? Although you don't want to just simply give your customers what they're asking for, you can start at the number that they gave you and decide whether you're going to give them less or more based off of what they've asked for. And then finally, the best practice calculation, which is finding an average between all the three calculations above. We don't recommend that you just do one calculation and only ever use that. It's important to try out all of these calculations and then maybe find a median credit limit based on all three. Factors that impact business credit report accuracy. So if you are using a credit report from a third-party credit bureau, such as like Experian or Equifax, Dun & Bradstreet, it's important to remember that although these credit reports are extremely helpful and should be a part of your credit risk management, you shouldn't be relying on these completely on their own, because of information like where the report comes from. And a lot of times there's incorrect data in the credit reports from these main companies. A quote from the VP of Product Management for Experian even stated that at Experian they're just reporting what's being reported to them. So if companies aren't reporting back that a company missed on a payment, then you're never going to know that. And it's not going to show in their credit report. So that's why calling the trade references is really important. They can also be a little unreliable because of how often the information is updated. Credit reports aren't real time, so it can take anywhere from 30 to 45 days or more for a credit transaction, purchase, payment, or missed payment to get from the credit creditor to the credit bureau. So you might not know that a company has missed the last payment for all of the creditors that they're borrowing from, because it hasn't been 30 to 45 days since it happened. So you can't rely strictly on those credit reports. And then finally, how the information that's coming from the third parties. Or sorry, I missed where the report is coming from. By using Experian, Equifax, or Dun & Bradstreet, they all have their own algorithms, and you may not be getting the same information from all 3 credit bureau parties. So you'll likely get different information at any given time. That was all that we had today in our presentation. It is 11:50, but we will take a few questions. If anybody has any questions, I'll give you time to put any in the chat box. In the meantime, I will launch our poll. So if you don't mind answering our poll question, and feel free to put any chats or Q&As in the chat box. In the meantime, also, we do these webinars once a month. So check back. You will be getting an email with a recording of this webinar, but you will also be invited to join our webinar for next month. So keep an eye out for that email. I'm not seeing any chats or Q&A, so I'll let you guys go. I hope you enjoyed our presentation. Thanks for joining us today.